Okay, thank you all for joining us today for this episode of the On the Mark Financial Forum and podcast. I'm excited to talk about today's topic, which is about refinancing during a downward rate environment. So it's an interesting topic because of the time that we're in right now. So as of this recording, we're in October 2024. We have come off of the peak of interest rates, which was almost exactly a year ago, October of last year. Rates have come down, they've spiked back up. We've had Fed rate cuts that haven't really done much to help consumer mortgage rates, but the expectation is that interest rates are still going to be headed in general in a downward direction. So the question is, how do we manage that for clients who maybe bought in the last couple years, who may have interest rates that are potentially higher than current market or higher than what they might be over the next handful of months? How do you handle that situation? So people who took out mortgages in the last couple of years, most of them, what we're seeing are somewhere in the range of 7 to 7.5%. The expectation, again, is that within roughly 2 to 3 years, we're going to start to see noticeably lower interest rates, but we're going to see some back and forth in between. And we've already started to see that. So if we go back just 1 month to when the Fed announced their 50 basis point rate cut, which was widely expected, but also an exciting thing to finally see just that transition from raising rates and then holding them higher for longer was the coin term that the Fed was using. Now we've started to see the Fed easing off. But what we saw afterwards was some financial reports that made it look like the economy was actually stronger than expected. So, and that came in the form of an employment report and inflation reports. So what that did is even though the Fed pushed rates down, those reports gave credibility to the fact that the Fed may not be able to just rush into dropping interest rates, and that consumer mortgage rates and other interest rate sensitive businesses may not be on a straight downward trajectory in a positive way, meaning. So what it comes down to in real estate is if you have a mortgage that's, let's say, in that 7 to 7.5% range, what do you do with it? If rates are, let's say, currently they're in the mid sixes, right? We're going to use some relative numbers to kind of illustrate some points that we'll be going through today. So these are not indicative of exactly where rates are for every single scenario, but I just want to give you guys a sense of how to approach these types of decisions. So if you're looking at a refinance for yourself, you'll know how to handle it. And if you're navigating this to help your clients, maybe as an agent or a financial advisor or attorney who's trying to add value to their clients, you'll know how to guide them properly. So the dilemma is, let's just say hypothetically, interest rates we're at 7.5%. Let's just say hypothetically, again, we're at roughly 6 to 6.5% now, and that the interest rates may go down to 4.5 to 5% at their absolute lowest point over the next handful of years. Maybe that will happen, maybe it won't. It certainly will not be a straight line if it is. We've already seen that again in the last just 30 days. We've seen things come down, spike back up, and that's actually pretty relevant to the discussion we'll be having today. So the question is, do you refinance now while interest rates are marginally lower, let's say roughly 1% lower than the rate that you may have right now, or do you wait for the bottom and wait for interest rates to hit that 4.5 to 5% level, assuming that actually happens? Nobody can really say for sure. One of the issues with waiting for the bottom is, number one, there are no guarantees that interest rates will ever get to that supposed bottom that people are anticipating. And what I always remind people is the same experts who are predicting where rates will be in 2 to 3 years are the same experts who were guessing that interest rates in 2022 would go from 3% to about 4.5%. And as we all know, they went from 3% to 8% at their peak over that subsequent year. So sometimes the experts are wrong, right? So we want to be mindful of that because nobody can really predict the future. The financial markets are constantly evolving, whether it be international events or other things happening domestically or elections or a number of different things that impact the market. So we really can't predict as much as we want to and rely on historical data and analysts and experts to be able to predict this. We really don't know for sure. So one of the issues with waiting to refinance is that you may completely miss the opportunity to claw back some of the savings that you're anticipating happening if you don't take advantage of them while they're available. And the other thing is people always talk about trying to catch the bottom with interest rates. But the question I pose to people is, how do you know when you've hit the bottom? You really don't. There's no way to know. And usually you don't know until several months after the bottom has already existed, to where you can kind of see, okay, the rates have trended back up. And now that low rate environment is now behind us. And now we're looking to the future for other events that may impact interest rates over time. So you never know where the bottom is. Even if you're locking in at the bottom, you won't know that that was the right decision until many months after that. So the idea is that you don't want to miss out, again, on that opportunity to claw back some of that savings in the meantime, so that you don't miss the opportunity completely and end up staying at that, supposed 7.5% in the example that we gave. And the third thing, and one that I think is most important, is to claw back savings in the meantime. And we'll go through an example of this, but what that means is, let's say interest rates are going to take 3 years to hit their new bottom, whatever that bottom is, right? You could stay at your supposed 7.5% interest rate until that happens, and then you refinance once. You only have to incur the cost of the transaction one time. That all sounds great, except what you don't see is how much savings you're missing out on in the meantime. And we'll go through a specific example, and I think the numbers kind of speak for themselves, as they always do, as far as why that may be important to start that savings sooner rather than later, rather than waiting for interest rates to come down a little bit. Because if, for example, you're saving, let's just say $500 a month, and you're waiting for interest rates to come down another 1/8%, maybe that takes another 3 months to happen. You've just lost out on $1,500 of savings because you were waiting 3 months for the rate to come down a little bit, where maybe it drops your payment by $50 to $100. So it's a little short-sighted to say, well, I'm going to wait for the absolute bottom and miss out on the savings in the meantime. We'll, again, go through an example of that, excuse me, in just a minute. So when we're doing an analysis for a client on a refinance, what we're looking at is what we call the break-even point, which is after how many months or years has the client saved as much as it cost them to do the transaction. So the monthly payment goes down, let's say by $500 or so a month. How many months does it take them to recoup whatever the closing costs were for that transaction? And there are ways to shorten that break even depending on the type of loan that you're doing. There are ways to make that period shorter than they would be otherwise, which, if you are going to do an interim refinance before we hit this supposed bottom, let's just say in a perfect world, we can predict exactly what's going to happen. And rates are going to hit 4.5%, for example. And you want to take advantage of that refinance in the meantime. One way to do it, and this is typically on loans backed by Fannie Mae and Freddie Mac, although it may apply to others as well, is that most people don't know that this is an option, but you can actually take a slightly higher rate than what the market rate would be. So let's say the market rate is 6%, maybe you take 6.25%, and in exchange for that, you get credits toward your closing costs. So it could be, let's say 1% of the loan amount, which for most refinances will cover pretty much the entire cost. So now you have the option of choosing 6%, paying all the closing costs, or 6.25%, a little less monthly savings, but theoretically limited to no closing costs. So your break-even point is almost immediate. So there's no way you can lose in that situation because, excuse me, you're clawing back that savings in the meantime. And if the transaction doesn't cost you anything other than a little bit of your time and energy, then your break-even point is immediate. It's kind of a no-brainer. So that's one way that you can potentially shorten the break-even point. What we're seeing often is that clients are getting called by the company that services their loan. They make always a really big push to go after their existing database of servicing clients, where they're, the people who are the companies who are sending you the monthly bills. And what's happening is they're giving just terrible advice. So they're saying, oh, we have this great rate. It costs you 2 points to get it, but here's the low interest rate. And when you're talking about paying points, what you're doing is you're increasing the cost rather than reducing it, and you're extending that break-even point longer. So now, if let's say you do a loan with a couple of points, and now the break-even is 5 years, but 2 or 3 years from now, the interest rates are meaningfully lower, and you decide to refinance again, you just threw away all the money that you spent on the first transaction. You didn't break even on that transaction before you did it again. So you're basically throwing money away. Now, most lenders, unlike us, care more about the transaction than they care about your well-being. So that's something you really need to watch out for if you're getting solicited by other lenders. You want to make sure in this environment, if you are potentially going to refinance a second time, you do not want to be paying points to lower the rate. It's just not a good idea because you're lengthening that break-even point. There are also ways, depending on how long ago a transaction was done, for a past client of ours, where we can reduce some of the costs. So for example, when you get a new title insurance policy on a refinance, it's generally less expensive than it would be if you were doing a purchase transaction. If we've done the loan less than 12 months prior, we can do what we call recertification of the value that was determined on the original appraisal. That costs about $200. Compare that to the full cost of an appraisal, which depends on the property value and property type, maybe closer to $1,000. So, and then you also, in a refinance, always have the option to roll the closing costs into the loan. That's advisable sometimes, sometimes not. But if you have a no closing cost refinance, then it's not really anything that you need to be concerned about. But there are ways to try, again, to get that break-even point as short as possible. Paying points will do the opposite. And so the idea is to try to find ways, creative ways, which we can help you with, to try to shorten that break-even point as much as possible. So I'm a big fan of examples, right? Because stories speak louder than me talking to a camera. So let's give an example. Let's say somebody has $1 million existing mortgage at a 7.5% rate. Let's say the going rate is 6.5%. And these numbers, again, are all relative. It's a 1% reduction in the interest rate, but the hope and plan is that interest rates 3 years from now drop to 4.5%. So like a 2 to 3% overall drop. So what we look at is how much is that savings over that period of time, the first 3 years, let's just say. And again, does it make sense to refinance in the meantime, or does it make sense to wait for the bottom? So the only difference, if you look at that, is are you going to be saving that 1% interest? And how much is that saving you? In this example, it's about $672 a month. Are you going to be saving that in the meantime for that 3-year period while you're waiting for that supposed 4.5% interest rate to materialize? And if you do the math, when you add that up over time, even over just 3 years, that adds up to almost $25,000. So if you don't refinance in the meantime, you're basically paying your lender $25,000 more than you need to in that window of time. Now, is that number going to make you retire early? Probably not. But it's much better, in my opinion, to be in your pocket than in your lender's pocket. So that's the idea of refinancing in the meantime, is capturing some of that savings in the meantime and being able to take advantage of that. If you wait to refinance until you get to 4.5, yes, you might eliminate the cost of the interim transaction that you do to save that 1%. In some cases, maybe that cost is reduced or potentially eliminated to where you're not missing anything because the cost is zero or close to zero. But if you wait all the way until that 3-year period, you're saving nothing for that first 3 years. You're still paying your 7.5% interest rate in that example. So it costs you $25,000 more. So let's say even there are closing costs on a transaction. Let's say there are $5,000 to $7,000, depends on the property type and location and loan amount and all that. But okay, so you reduce that from the $25,000 that you might save in that example. It's still a significant amount of money that I'm sure you would rather have in your pocket or your client's pocket than in the bank's pocket. So that's kind of the idea behind how we approach these discussions with clients. Are there ways to reduce the cost to be able to shorten that break-even period if the assumption is that interest rates are going to continue downward? Again, we're not going to see rates just all of a sudden fall off a cliff. That is not how it works. We're not even going to see it go down on a straight line. And we've already seen this. We've seen it go down. We've seen it go back up. And now hopefully we'll start seeing it go down again. But it's always, when you look at interest rate charts, it's always a jagged line like an EKG. It's never a straight line. If you stretch it out over a long period of time, you'll start to see those bumps even out because they're just temporary. But we do see sometimes that there are peaks and valleys with interest rates that you want to try to capture. The ideal scenario is that you capture them on a day when things spike downward. And those times are very fleeting. And I can tell you this from example, just in the last 2 months, we have clients who were very proactive, got us documents in advance. Interest rates were declining. They locked at a time when we thought it was a good time to do so. And then within days, probably 2 days, that window of opportunity was gone. And the whole refinance might have not made sense because the interest rate shot back up by close to 0.5% in some cases. So those windows of opportunity can be very short to capture them at the bottom of that dip. And that's the ideal scenario that you want to do. So if we look at the ideal approach, like if we're looking at absolutely perfect circumstances, which I know is not reality in real life every time, but what we recommend doing is having a consultation well in advance, even before you submit an application, and determining what your strike rate is. So at what rate do we say go? If you're at 7.5, maybe that's 6.5. Maybe depending on your loan amount, that number could be different. So the drop in interest rate affects a larger loan more than it affects the payment on a smaller loan. So if you have a $200,000 loan, for example, you might need the rate to go down at least 1%, if not more, before a refinance would be potentially justified. So these are all relative numbers, but the idea is that you establish with us up front what the actual rate is where it makes sense for you to refinance, and that's the rate that we try to capture for you. Because the interest rates are constantly moving, we want to be able to move quickly when that opportunity presents itself. So what we recommend is starting an application when rates get within roughly 0.25% of your strike rate. We get the application underwritten, we get the appraisal done, we get everything moving, and then we're just waiting for that opportunistic moment to actually lock in the interest rate. Because people oftentimes think that you have to lock the interest rate as soon as you apply for a loan. That's not the case. You have the ability to decide, and the beauty of a refinance transaction rather than a purchase transaction is that there's no seller forcing you to close within a certain window. So if we're hoping that 4% drop will happen within a month and it takes 2 months or 3 months, then so be it. We keep the application active and we just wait for that opportunistic moment to strike and to lock in the interest rate. Another thing people oftentimes don't realize is that the rates are just a fraction, but they are a little bit better if you lock for a shorter window of time than for a longer window of time. So if you start an application and you're locking in right away, you're locking in, let's say, a 60-day rate lock. That's the kind of industry standard. If you're further into the process where you've already done your underwriting, you've already done your appraisal, you might be basically done with the underwriting process and just waiting for the right moment to lock. And you could potentially lock for a 15-day lock or maybe shorter if it's offered. And usually the terms on those shorter term locks are a little bit better than they are in the long-term lock. So it puts you in a better position to capitalize on that lowest possible rate if it happens to become available for a 15-day lock, but maybe not for a longer term lock. And the idea is that once you lock in that interest rate, if you've already gone through the majority of the process, you're closing pretty much right after that, within days of that rate lock, if that's the final step. So you get to start enjoying the savings almost immediately after you lock the rate, or within, let's say a week or two, and start that timeline for when you're increasing that savings. So these opportunities, like I said, the rates come down, it's a fleeting opportunity. It's quick. And we saw this already happen just in the last 30 days, where there was a short window of maybe 2 or 3 days when rates kind of hit a bottom and then they bounce right back up. unexpectedly, because everyone was thinking that as the Fed drops rates, the mortgage rates are going to go down as well. That's, as we've seen very clearly in the last 30 days, they can have an absolutely opposite movement. So we need to be mindful of that. But the ideal scenario, identify your strike rate in advance, apply when you're about 0.25%, give or take, within the range of where your strike rate is, get your application moving as far along as you can, lock on that opportunistic day, and that's how you win with refinancing in the meantime. And if we do the analysis and we say, you know what, it's just not worth it to do an interim refinance, and you should probably wait until they hit a real lower bottom, then so be it. But at least you have a plan in place to know exactly what the right approach is for your particular loan, because everyone's situations are different. Sometimes employment might be changing, or your credit score isn't ideal right now, but it might be better in 6 months. Or, you know, maybe you have a smaller loan, so it's going to take a larger reduction, in which case it might not make sense to do an interim refinance. And maybe you do just wait for that bottom to happen. But without the consultation, you won't know. You're shooting in the dark. You have no idea if you should make a move on that or not. And that's something we pride ourselves on, is staying ahead of these trends and helping our clients navigate this type of situation before it materializes, so you're not scrambling once something actually happens to your benefit. So so this is going to be a real short session today. I don't see any immediate questions in the chat. I'll hang on here for just a second, but that's pretty much all we've got for today. I just wanted to go through this strategy and have you guys help yourselves or your clients figure out how to navigate the situation. Of course, we're always available if anybody wants to do that consultation with us. We would be more than happy to do that and try to find ways to shorten that break-even period and take advantage of those very temporary dips in interest rates when they materialize. So I appreciate you guys joining us today. Have a great day, and we'll see you on the next episode of the On the Mark Financial Forum and podcast. Have a great day.